Hello, this is Ed Butowski. Welcome to another edition of Wealth Transparency. What we do every week is we take headlines that are not front page news stories, but are very important and very telling as to how they impact your investment portfolio. And we discuss them and talk about what you should do with your portfolio as a result of that. I am joined here, as I do every week, by Michelle Connell, who is the head of Portia Capital Management in Fort Worth, Texas, and Andrew Tang, who is the Chief Information Officer at Turner Financial Group in New Jersey. So thank you both for joining us today.
Thanks for having us.
Thanks, Ed.
So Michelle, I want to start with you and talk about an article that was in the Wall Street Journal about America's low hire, low fire labor market, and talk a little bit about how the job market is looking right now.
Well, when we look at it from the surface, things seem fine when you look at the unemployment numbers, and they're pretty good. But when you look at the job creation, which was referenced in this article, things have really slowed down since 2024. Last year was tough, and this year's even tougher. So at some point, if we continue on the current trend, it's going to be a problem for individuals that are looking for work, whether they're coming back to the workforce or they're coming into the workforce for the first time. I think it's going to become more of a problem. You're seeing individuals already who have lost their jobs. It's taking longer, and that does affect not only spending, but consumer sentiment, which if you're not getting a job, your sentiment's not going to be great.
What do you think the reason is for the bad job market?
I think that companies want to keep profit margins where they are without, even though their costs are going up, they want to keep profits stable. And how do you do that? By lowering the number of people you hire if seats are vacated. And I think that's the number one issue right there, is we want to have that consistency not only of sales growth, but of profit stability.
And Andrew, how do you feel about the jobs market?
I think the job market is shifting. It's transforming, but it's not exactly heading the wrong way. For example, we can tell by consumer spending. Consumer spending is still quite strong. And we see the latest revision for payroll in July came in at -23 while we were expecting a positive number. And then June and May altogether, they were revised lower, right? So the jobs number in terms of unemployment and payroll, unemployment has shot up and payroll has shown that it has gone down. But overall, we still see that, I still see it, that this job loss or lack of increase in payroll is offset by new business that are forming. So altogether, for example, if you do year to date up to July, what is the actual job losses, the number that was announced, compared to, the actual number of people that were fired? It's roughly about 477,000 year to date up to July. But if I look at the new business formation report as of July 11th, somewhere around there, new business formation came in at 553,918. So it takes at least one person to start a new business, right? So that goes to show you, well, first and foremost, this data is not reported. It's exactly what this podcast is about, that you don't get to see this, but this is directly from Registered Agents Incorporated, RAI. And that report comes on a monthly basis. So we can see and understand that the amount of companies that are forming year to date offsets totally of the number of jobs that are, the layoffs that has been announced. So you can see this just shifting. Now, government workers, they are being laid off because, government is being downsized right now. And that is a process that is ongoing. But outside of hospitality and healthcare, companies are not exactly hiring. It's exactly what Wall Street Journal article is talking about. So it's a real test for corporations to deploy the technology and the innovation stack to see that if they can get the productivity in return. And so that's what's happening in the labor market. It is transforming, but it's not necessarily decreasing.
Now, during the Biden administration, a lot of the jobs were government jobs. And what the Trump administration is doing is trying to downsize government. So that's another reason why you see such a difference in the numbers. But I wonder if you were to look at during the Biden administration time, if you took out the government numbers, what those numbers would have looked like.
Yeah, we would have been in a recession. We would have been in recession. And that's exactly why we didn't call it a recession, during that time. And when we look back, government spendings were huge. And there were a lot of overhiring at the government level and also at the corporate level. And we are just starting to rewind that. And as 2022 came in, when cost of capital starts to go up, you can see that corporations were starting to lay off, but government was still hanging on to those workers until Donald Trump came in, right? And with the Doge, the department, they started putting shining a light on this, area and say that, we need to reduce government spending and we need to start to basically make government infrastructure more efficient. And so, whichever side you're on, in this argument, we can still see that, government workers are being laid off. And those are the ones that may have a harder time to transition, out, when compared to private sector.
So, we talk about corporations and how expensive things have become for them. And that's one of the reasons why there might have been layoffs from big companies, is because of the big expense of having employees or having a number of employees. Another reason that we've seen this is the rise of oil prices. And now, it seems to be the norm around $90 a barrel. But one of the reports out recently says that we're using 4.3 million barrels per day. We're producing 4.3 million barrels less than we were recently. So we have a bigger demand and less supply right now. Michelle, how do you see this impacting corporate America?
We're going to continue to have pressure on costs for corporations, because if oil stays at $90 a barrel, that's going to make it difficult not only on companies, but as we talked about last week, also on consumers. If you're talking about the average middle class individual is paying 10% of their household budget to oil, that's going to affect companies as well. It's not only their cost, it's what consumers will be able to spend if they're spending more at the pump.
What industries do you think are impacted the most outside of the energy industry? But which companies type, like PepsiCo has the second biggest trucking fleet in the United States. So they would be impacted quite a bit. What other businesses would be impacted due to the high oil prices?
Andrew, you want to take that?
Yeah, it's really about transportation. It's all in the DJI. It's all in the transport sector. So whatever vessel that you need to work with, it comes with jet fuel, right? And also shipping, marine fuel, and also truck fuel, diesel fuel. And then on top of that is, as it comes to the closer to the delivery, then it's all gasoline. And so there's a lot of bottlenecks here as well. In terms of refinery, I think that's more of an issue when it comes to oil. And yes, we are, seeing the reserves starting to deplete. But again, I would also like to mention that a lot of the numbers are reported by OPEC and OECD, which stands for the Organization for Economic Cooperations and Development. That's a long name. But there's one tiny country that just recently, if you remember, that had announced that they're leaving OPEC, right? And that's Abu Dhabi. UAE. So they are quietly increasing production to offset the oil that is not passing through Straits of Hormuz. And they're very blessed to be in this geographic situation where they can have the pipeline to send to the other end of the Strait of Hormuz to bypass the conflict area. So quietly, you're not hearing this, but the fact of the matter is they're at least producing about 4 million barrels per day right now. So that has been offsetting the lower production or the lack of transport or the closure of Straits of Hormuz. I think the oil situation, and you can see the market's reaction, is actually quite benign. And these are the forces that are working behind the scenes that is making this price point equilibrium more comfortable. So it seems like there is this unspoken harmony that exists out there, and everybody's scratching their heads like, why is this happening? Yes, oil's at $90 a barrel, but the gas is still $4, a gallon. It's not the end of the world. We saw $5 a gallon across the United States before, for a short period of time. So, there are opposing forces. And then you have to, talk about long-term and creative destruction of oil as well. COVID taught us to basically be more persevere, look for different supply chains, and look for different sources and look for different solutions. And from that point of view, alternative fuel is coming to a larger play, in the recent years versus years before. So there are many forces that are happening that is giving comfort, to this particular area, including businesses all the way down to the consumers.
So we're obviously in a global economy. I remember when I was at Morgan Stanley, we had a portfolio called GlowCow, and it had to do with stocks in the United States that did the majority of their business around the globe. And you'd be shocked at the names. They were really, really popular names. And Japan happens to be a very important retail trading partner of ours. And they're starting to price in another Bank of Japan rate increase. So why would you see Japan increasing their rates while other countries are looking to decrease their rates? Michelle?
Well, part of the reason is energy costs. They're just being crushed with high energy, just like the European Union and the UK. And so that's one of the main reasons why Japan is going to keep their rates high, if not increase them, just like the EU will probably do the same. But why it's more important that Japan's going down that road is that they own about 13% of our bond market. They've been a consistent buyer. Actually, they're the number one buyer after a distant China, which is about 7-8%, and that China's been decreasing that amount. So if Japan has higher rates at home, it would make sense for them to buy more bonds of their own country versus continue to buy the U.S. bonds. So there may be some issue there where we may need to raise rates in order to increase attraction of foreign buyers.
So, Andrew, what's your view of the Japanese market and how is it impacting Korea, South Korea, China, Vietnam, and the Philippines?
Yeah, I think something really important happened last week that I don't think the major media talked about, and that is what Japan did. Japan sold a ton of U.S. Treasuries, and that's why we saw the 10-year yield creeped up close to 5%. And that's what happened. At the end of May, they sold about 1.1 trillion in U.S. Treasuries. And the reason why they did that is because they needed the money to support the yen, to support their own currency. And that's when Scott Bassett came in. Remember, you saw that in his little notepad. He wrote buy JPY, right? And what was Scott going to do? So U.S., instead of selling their own treasury, we won't do that. And we didn't do that. What Scott did, was we sold euros. We sold euros. The U.S. Treasury sold euros and supported the Japanese yen. And the reason why we need to do that because Japanese yen against the dollar were falling. We're falling because they're losing purchasing power. Inflation is something that Japan wanted a long time ago when their rates were zero. They wanted to get out of deflation, and boy, they got it. They got it plus some more. So inflation in Japan creeped up from about 1.3, and now it's tipping off to 1.7. So that really scares the central bank and the Japanese authorities, and that's why Japan is increasing rates right now. I mean, I've never seen rates in Japan, has gone this high before, for many, many decades, and that's why. And this is what happened. So the Japanese yen is falling against the dollar, and U.S. has decided to support the Japanese yen. And their movement in the recent weeks is what's caused the yield to go up in U.S. Treasuries. And that's what's going on.
So, Michelle, you and I have clients, and we diversify their portfolios. And I'm sure you have some emerging market ETFs. I do. And they're a small component. So I oftentimes don't really look at it as frequently as I do other positions. But recently, you've seen a lot of money flowing into the emerging market funds. What do you attribute that to?
I attribute that to the fact that you've had a lot of technology companies in that part of the world that are beginning to get traction. And so those companies have been cheaper. Those technology companies in emerging markets have been cheaper compared to the United States markets in that particular sector. And so you've seen money go back into emerging markets. But I would make the case that, yes, that's a good reason to own them. But at the same time, those countries are growing faster than ours. They have a much younger populations than we do in the United States and in the developed part of the world. And it's important to have exposure, whether, it's popular or not, because those countries are becoming a bigger part of the world GDP. And you don't want to just own the United States in isolation, especially when they're putting more emphasis on AI and technology as well. I think we'll continue to see them do well in those companies, just like us.
Yeah, and it always drives me crazy that China, which is the second largest market in the world, is still considered an emerging market. I don't know, how that's the case. But Andrew, why don't you take us through your emerging market world?
Yeah, that's a great point, and that's a great argument that, with the WTO, the World Trade Organization, that China should not enjoy the benefit as an emerging market label, right? And that's how they have gotten all these incentives that were really not fair, as the second highest economy or the largest GDP economy in the world. That's a great point there. But the inflow that we saw recently is the offset of the outflow that came out of emerging markets, in the beginning of the year. So this is just a rotation, if you will. And I think this is due to the valuation and looking at, the U.S. markets, it is quite pricey. You can say it's priced for perfection. And you can also say and put an argument that, this is still not proven, right, when it comes to the AI infrastructure build. So there are the believers and there are the non-believers. And the non-believers are looking for a different way to diversify for the clients' portfolios. And in emerging markets, it's a reasonable one that is well diversified. In addition, when compared to the developed non-U.S. economies like Europe. Mm-hmm.
Yeah, and in fact, that leads me right into Europe, because Europe is facing a really tough situation with higher inflation and sluggish growth. And this is mostly Eastern Europe. See if I had that right. Yeah, Eastern Europe, that's Spain and Italy and France and so on. I mean, these countries, what I've always known is that if you're not going to reward money goes somewhere else. And they tax so much in those countries that it doesn't really pay to be innovative there. And in fact, I've gone to Europe many times and I asked people, when was the last original thing that was ever built in Europe? What was the last great thing that was built, not improved on, but created? And nobody can answer me. I didn't make a lot of friends in Europe.
Why, Ed?
I can imagine, yeah.
People, I said, what was the last thing that you guys invented?
Yeah.
And, and they're like,
they couldn't tell you.
No. Can you tell me anything that was invented in Europe?
Socialism.
I mean, and so when you look at the spectrum,
regulations,
you have frontier markets, you have emerging markets, you have the United States, then you have way over here in the sluggish world, you have Europe. And now they're facing high inflation and a sluggish economy. Michelle, would you put any money in Eastern Europe?
I haven't, and I haven't put a lot in the EU in general, but I would also say it's not just Eastern Europe. If you look at, I was reading an article recently because I do business in the UK and I'm kind of an Anglophile, but they have no growth there either. And when you tell people, in the EU and in the UK, that you have your own business, they're like, that would never happen there. Because they don't have that bent towards entrepreneurship. And I think that's part of the problem. Now they have, on top of the lack of growth and, entrepreneurship, they have additional costs that have been put on them from the Middle East conflict. So they are mad. So I don't know if I'd go over there right now as an American, because their energy costs are just through the roof. And they already know that this winter is going to be tough in terms of people being able to just live. And a lot of the governments are already queuing up programs, part of socialism, Andrew, that they're going to help offset those additional costs because there's so many people that just can't afford to live because they don't have that growth. And at the same time, they have increasing prices. And they also have people that, this is a generalization, their youth, they don't want to work. They really don't. If you look at the levels of work for people under 30, 35, it is really low. And how are you going to grow an economy if you don't have your younger population growing a career and then having children and buying stuff? They don't have that.
That's right. All I think about is when I think of people in Europe, younger people, I think of them making their hair purple and then piercing their faces with stuff. And that's what I think of when I think of a young 25 to 30-year-old in Europe.
Well, it goes back to, and even their own population will tell you this, if you're subsidized not to work, then you're not going to work.
Yeah.
And that's what happens. And so even if you work, you're not going to work full time. You're going to work as little as possible. That's a generalization, but that's the problem. And now that's also why you've had so many different prime ministers. It's like a revolving door, right? Like every year, you can't solve the problems that are like intrinsic to that type of economy.
Yeah. And if I can jump in, this is just a ticking time bomb, and there are two aspects to this. One, when it comes to investing, going back to your first question, Ed, would you invest in euro right now? I would say very selectively, very, very selectively. Like, for example, ASML, ARM, these are companies outside of the US. I do like them. There are a lot of biotech companies, pharmaceutical companies doing research on life sciences. Beautiful company, Teva Pharmaceutical. There are a few of them. But I have to be very selective. I don't even want to buy a basket of them in an ETF, for example, because if they are in a good ETF, for example, that have a good theme, then they will include the non-US companies as well. But for the individual stocks, we're going to have to be very picky. We have to be very choosy, and we will be very selective on the names. I would never buy a generalized ETF like an EFA or, like a European ETF, generally speaking, just for diversification's sake. Why would I do that? Because then you'll get the mediocre returns. Okay, so outside of that it's also a problem of lack of innovation. The regulations pile on, compounds, and over, it becomes a place that you can spend money but not make money. There's no innovation when you have so much regulations, and their policies is to reward and create an incentive to not work as hard. So just like what Michelle was saying, that when you create that incentive to not work as hard, they will ask themselves the question, why are you working so hard? Why are you working so hard? Just to get by, that's enough. And the rewarding entitled program is so well that rewards people, then it becomes a magnet for the migrants as well. Look at all the migrants from Africa, from all the emerging economies. They want to go there because they want to live comfortably. And so, yeah, they regulate themselves, out of any innovation. There's no good capital markets over there for anyone with innovation that wants to, let's say, start a company and grow. They want to come to Silicon Valley. Even when it comes to higher education outside of, a lot of the Oxfords and the great universities in Europe, they do want to come to the US also, because this is where the American dream lives and breathes, and it's alive here. That's why I'm here. And so, yeah, it's very different. It's night and day. US is still the place to be when it comes to growth for the next decade. Mark my word.
So I want to thank both of you for joining today. I rarely do this, but I want both of you to let people know how they can reach out to get your newsletter or any information from you. So Andrew, you put out a wonderful piece each week. How can people sign up to get it? What's your email?
Sure. They can reach out to you, right? Because this is your podcast and you're the main connection here. They can reach out to you and you can just, let me know who wants to subscribe to the newsletter on a weekly basis, and I push it out and I'll include them. You can also send an email to me, andrew@turnerfg.com, and I'll be more than happy to add you to the distribution list. Thank you.
And Michelle, do you have something that you send out each week?
I send out the podcasts. I send out articles and contributions that I make, that I write in any media appearances I make. So if somebody is interested in those, my email is Connell, Connell, one word, at Portia, Portia, hyphen, that's a dash, the word capital.com.
Great. So thank you very much to both of you. Now, anyone who's watched this, I hope you appreciate the knowledge that both of these individuals have. And if you can and feel like it, please share this with others. We're trying to build up our audience, and the more people that watch this, the better it is for us. So thank you very, very much, and we'll see you next week. Thank you.
Thanks, Ed.